Welcome to the video on journal entries and adjusting entries. And this hopefully will be mainly a review, but at the same time it may not be, maybe some new things in here as well. We're going to do two approaches for the recording and also adjusting entries. First one we're going to do is we're going to do assets liability approach, which is what you learned in financial and or accounting 1, and we're also going to do the revenue and expense approach, which is a way of recording initially, and it's used by the majority of the companies because it's the easiest one to teach the employees how to do, because basically you'll tell them if you receive a check it's revenue, if you write a check it's an expense, and that's how they record it, and then you'll adjust it at the end of the month, the end of the year, whenever you do the adjusting entries to take care of it. Okay, we're going to do different types of adjusting entries and journal entries at the same time using both of these approaches. And the first one we're going to talk about is deferrals, and we're going to talk about deferred expenses. And now these are expenses that are basically prepaid, but they're not an expense yet because you haven't really used them. So another one would be like office supplies, rent would be a deferred expense, prepaid rent, that type of thing. We're going to do the insurance one. The company purchased a one-year insurance policy for $18,000 on October 1st of 2015. Now that's for 1 year. Now your initial entry would be then $18,000 for both of them. And on the other approach, the revenue value, instead of putting it into prepaid insurance because you paid a year ahead of time, we're going to go ahead and put it in directly into the insurance expense in cash. So this is still just as correct as the other one. But the only difference is we wrote a check for $18,000, so we told them put it next into the expense account. Now over here then, that's when we'll do the adjusting entry. For the prepaid insurance initially recorded as, we need to put it into the insurance expense, and the amount we need to put in is for the amount that we have actually used up. So we take the $18,000, since it's a one-year policy, we divide it by 12, and then we'll take that times the number of months that we've had it, which would be, since it's October 1st, it'd be for 3 months, or $4,500. Okay. Now, on the revenue expense approach, the question's a little different. We'll still divide it by 12, but the question on this one is not how much have we used, how much is still unused, or how much will go into the next time period. Okay, so that is going to be, since we've used 3 months of it, we still need 9 months into the next time period. Okay, and that gives us 13.5. Now let's look at this over here, just a little side note. On the prepaid insurance account, we have, let's do this approach here first. We started with $18,000. We took out $4,500, so that leaves us $18,000 minus the $4,500. Try this again. We had 18,000 minus the 4,500, or 13,500. I don't know what I did with the first one. Okay. On this approach here, we started with 18,000 in the insurance expense. We took out 13.5. So take 18,000 minus 13.5 and leaves us 4,500. Okay, so you notice the 4,500s are the same and the 13.5s are the same. So your end results are going to be the same. It doesn't matter which approach you take, it's just a matter of how you do the adjustments. All right. Now for the August 30th, on this one, deferred revenue. This is where we receive, like magazines. If you work for the insurance company, it would be prepaid, it would be unearned revenue. Okay. Now I know unearned revenue causes a lot of problems sometimes, but that's what this, this money that you received that you haven't earned yet for services to be performed in the future. So we use a magazine subscription company. This one is the monthly report, received $6,000 for annual subscriptions on August 30th. So this is going to be simply 6,000. 6,000, and this is going to be 6,000 still. But you notice the credit account did not go into the unearned revenue account, it went directly into the revenue account. Again, this is the revenue expense approach. Okay, so over here we want to look at how much have we earned. Okay, so we take the 6,000 divided by 12 times, okay, how many months have we had? Since this is for August, well, 30th, so we start with September through December, so we've earned 4 months of it. Okay, so that would be the $2,000. Over here we want to do the same approach, but again with a different question. We don't want to take it times how many months we've earned, it's how many months have we not earned. Well, since this started August 30th or September 1st is when the month actually started, you have not earned 8 months of it, or $4,000. Okay, that's the difference. It's this initial recording here that is the difference between the two approaches. Do you put it into an asset or liability to start with, which unearned revenue is a liability, in case you forgot, prepaid insurance is an asset. Over here, we put it directly into the revenue account and then adjust it into the unearned account, or we put it directly into an expense account and put it into an asset account. That's why it's called the revenue expense approach. Okay, those are the two that are really the difference. After that, they're going to be the same. Okay, so for accruals, accrued expenses, this is when you haven't paid the expense yet because it's basically not due yet. Okay, so in this one example, we have an ABC company borrowed $10,000 on November 1st. For 1 year, interest rate is at 6%. So we initially have cash of $10,000 and we have notes payable of $10,000. And this side is going to be the exact same thing, which you'll find now they will be. Now for the interest expense, this is at the end of the year, we have to record the interest. So we would take the 10,000 times, okay, interest rate is 6%, times how many months did we have it? Well, just 2 months divided by 12, or well, it's $100 worth of interest. And I got carried away there. Okay, and that's going to be $100 and $100. Okay. So it's 0.5% a month. You want to look at it that way. All right, on this one, we have accrued revenue. This is just the other way. This is where you have earned it, but you haven't received it yet because it's not due. An example on this would be because of notes. In this one, the XYZ company accepted a note for a past due account from CDF company for $9,000, charging 9% interest, due in 1 year on March 1st of 2015. So again, we put it notes receivable, and we're going to credit it accounts receivable because it was for a note. It was for an account that was past due. So we just give them a note instead. Okay, you'll have more on this on that chapter. But what we're interested in is the interest that you've actually earned, because you did this on March 1st. So you've earned 10 months worth of interest that you need to record. So we'd have 9,000 times, it was 9% times 10/12 of the year, or $675. Okay, and that's what this will be the same over here because nothing's changed on this side. It's only the first two that are different. And the last one we're going to cover is for review is the depreciation method. And we're just going to do straight line because that's what we'll do in this chapter. You'll get other methods later in the course. So on May 1st, 2015, the company purchased equipment costing $8,000. Used straight line nearest month allocate method for the depreciation, and they had a 5-year life with a $500 trade-in value. So equipment is going to cost, it's just recorded $8,000. And we're going to assume cash for everything in here to keep life easier. Okay, so nothing's changed here. Okay, $8,000. Now for the depreciation, we would take the 8,000 don't forget to subtract off the salvage value, divided by 5 years, times, well, it's for 8 out of the 12 months because it's a partial year. So it's $1,000. Okay, and then this side is going to be the exact same thing. Nothing. Okay, so keep in mind the only difference between the two methods is up these first two right here for the deferred expenses and deferred revenues. That's how you initially record them. That's the journal entries and adjusting entries for this one. So I'll do the next video for reversing entries.